But so before we get started, we have some pretty big announcements. There's a relatively new club in the College of Engineering. They're called the Florida Intellectual Property Allegiance, and we're going to be partnering up with them to do a joint workshop. This is the first time we do a joint workshop like this, kind of like planned properly. But it seems like it's going to be a big event. We're capped at 60 seats. So far, things are like a lot of college engineering students want to get into it. If this is something you guys are interested in, I highly recommend you guys sign up for it. The sign up link should be in our link tree in the bio of our Instagram. I think is it also on our website?
Yes.
It's on our website. But yeah, Ryan Wilson, JD, going to be talking about intellectual property with startups. It's going to be a good one. He's also a UF alumni. Do the attendance real quick. Just take a picture. Yeah, we'll just go back to it. Let's go back. Okay, and
yeah, so next week over at the Santa Fe CIED Incubator, we'll be hosting our pitch competition. So far we got 13 companies signed up, 9 will be pitching, and yeah, it's looking like an interesting event. You guys want to attend it and kind of see how these pitches go, see how that interaction happens between the judges and the startups. Today I actually judged a pitch competition at the CIED that was an in-house for them, and represent Warrington Ventures, and it's a good way to see that kind of interaction and how that unfolds, what a pitch deck looks like, you know, under pressure, how entrepreneurs can answer questions. But yeah, we're excited to see how that event turns out, and so far it's shaping up to be a good one. Reach out to us if you guys want to attend.
And then this is another big one. There's a lot of things lined up next week, but this one's really exciting. It's kind of like the last part to our evaluation series. We're going to be doing an LBO workshop with the IB/PE sector from FPD. This is the first time we collab with the Finance Professional Development Program, and we got a lot of cool stuff planned. We're going to have an interactive LBO to send to you guys, a lot of cool examples, and they're actually going to come here and present with us. So that's going to be our next GBM. So on Thursday, same time, same place. Right here. So yeah, if you guys have any questions about that, feel free to ask. Some updates for this week. If you guys are new here, something that we do is try to give you guys as much transparency of what we're doing in the background. We try to balance that with also the nature of the projects that we're on. A lot of the projects that we're on require us to sign NDAs. So we like to attach titles to some of the projects that we're on as of late. But for example, Project Horizon is an engagement we have with UF Innovate. We already have analysts who have signed NDAs. Well, we signed on behalf of the analysts, but they're working on a market research project for them, working diligently. And for the new analysts that are here today, new projects are coming. We have a really big one that's coming October 24th. One of the teams that we basically allocated you guys to will be on that new project. So stay tuned for that. And whoever doesn't get onto a project for this next big one, or the one that we have after that, we have a generalist track that we're going to go through with you guys. But you guys should be receiving an email on that pretty soon. Today we're just going to keep it very broad and keep it to our normal scheduling. But you will receive more information about that generalist part, just to keep you guys not doing nothing in the background. The CIED competition, we already spoke about this, and like I said, we accepted our analysts already. If you haven't gotten anything from us, please let us know. It was difficult picking everybody out one by one, but yeah, happy to answer any questions about that. If you want to say anything there.
Yeah, just feel free to let me know if you have any questions or any concerns about the MS program. Always happy to help.
Like I said, just to increase the transparency a little bit more with the club, this is everything we have working on in the background. Project Horizon 1 and 2 got split into 2 because we have 2 new projects for that engagement. We actually got a date for the new project that's coming in. It's October 24th. Seems like it's going to be a big one, probably similar to the ones we've had in the past. So stay tuned for that. And we're doing a lot of planning in the background for these workshops and for BCIC in specific. If you guys are also new, this is the venture capital investment competition. We actually competed in this last year and got 3rd place. It's unheard of for the first time the school goes to this competition and actually places. So it really put us on the map. And we actually got selected to host this competition this year. So it's going to be a big event. I'm sorry, it's going to be in February.
February 24th.
February 24th. It's going to be big. We're going to have a lot of VCs come to campus, a lot of venture lawyers, maybe some private equity people, we'll see. But we're going to have some big events that week. If I'm not mistaken, I think that's the same time as the Tech Week. Angel Tech Week? No?
I'm not sure. I can check.
I think it's the same time as like another big summit that a VC firm local to Gainesville does, but stay tuned for that. Yeah.
All right, so this week for our current event discussion, we're going to be looking at Form Health. So it's a drug called Ozempic and Wegovy, and they're drugs that allow you to quickly lose weight. It's about 15% of average weight loss whenever you take this drug. So for obesity problems in the US, it's been something that's caught a lot of traction, especially on TikTok. People would show their results, and it just caught a lot of traction. So the founder of Form Health saw that their advertising and marketing costs dropped by 90 to 95% whenever it started going viral on TikTok, and it allowed their company to grow to 4 to 5x in a year. So how does free online marketing play into industries? Anybody have any ideas? So specifically with social media, it's just kind of the easiest way to find free online marketing.
Well, this is discussed in the book Zero to One by Peter Thiel, but in essence, when you have the reason why viral marketing is so effective and so many companies have been trying to utilize it is because it just basically makes your customer acquisition costs just like employment. And so that means you'll get basically make more profit if you have a successful viral marketing strategy.
So when you are in one of these viral markets where there's a specific product that is going viral, in this case they don't have a patent on these drugs, but they're some of the ones administering and selling these drugs, how do you set yourself apart from the other companies that are also selling these same products?
I feel like, again, going viral on TikTok, I feel like it would help build your brand awareness. So again, like if someone is looking for something like this, they could be like, oh, did you hear about Form from TikTok, whatever? And I think, you know, that's a key aspect of social media marketing. I feel like it does help set yourself apart from competitors, and I think that's why a lot of people do use it.
Also, just having a good brand image in this, and what I mentioned specifically is quality. A lot of these viral products get stock. So if you set yourself apart by being actually effective and having repeat customers, that goes a long way in maintaining sales.
And then the final one for this current event discussion is with these healthcare companies that are VC and private equity backed, they have to balance their need and want to grow and establish a bigger profit revenue base, while they're also providing healthcare and services to those that need it. So how do you think morally they should be balancing these two, and how do you think the companies actually do, such as Google?
I think transparency plays a huge part, like being transparent about like the product that you're bringing to the market and its like effects and like who should really be their audience, who should be using it and like wanting it. And then yeah, just everything else, just kind of like the details of the product, like just letting everyone know like what's actually in it and what it's about.
Those are good points. Have you guys heard of the pink sauce on TikTok? Yeah. That's something like that, where transparency should have been a higher factor there.
What is this? What was it?
It's like this lady on TikTok that started selling like pink sauce, and it went viral, and she started sending a bunch of orders, but since she used a bunch of like dairy products within the recipe, it would spoil in transit, and people would eat it and get a bunch of stomach problems. And it wasn't FDA approved or anything. So it shouldn't be anywhere.
Wow. That's good.
Is this FDA approved?
Yeah. Yeah.
Like I've heard of it a lot in like commercials. It's like Ozempic, like, and then it's like, oh, it could do this, and then it's like, oh, but you could die.
Does the company just distribute the drugs, or do they actually manufacture the drugs themselves?
They do both.
Alright, so gotcha.
So like vertical integrated? Cool. Yeah, like we mentioned last meeting too, UF students have access to PitchBook. So if you guys ever want to research more in depth these companies that we present to you guys, feel free to log on to Facebook and yeah, take a deep dive.
That's where I found this. So we're officially halfway through our meetings for this fall semester. We'll be coming out with a schedule for the spring soon. We're still working on that. And then again, next week we have that big meeting with FPD where we're going to be collabing with them to give a great presentation on LBOs. And then again, today we're going over VCs, which is our bread and butter here at Worthington Ventures. So fund structure overview, and then we'll be going into the 3 dimensions of venture capital and then venture capital philosophy. So what is venture capital? So venture capital is, they're buying into companies similar to private equity, but they're typically looking at companies that are less developed, closer to the pre-seed and seed stage, and they're looking for high growth potential because a lot of these companies do fail. And this market is approximately $63 billion in size. And some of the key terms is the term sheet, which is the agreement between the VC fund and the company they're investing in. Runway is the amount of money that a company needs to get off the ground and hit certain milestones so that they're able to become profitable. Angel investors are singular investors that have large amounts of money that can do this, that can invest without VC backing. A minimal viable product is just a prototype of sorts before they really have their product down. And then you can buy into a company with shares, and then vested shares are shares that grow as the company grows as well. So fund structure is very similar to private equity fund structure. So you have the general partner and the limited partner. Limited partners are the ones that are investing money and giving money to a venture capital firm, and they'll then go and find companies that they'd like to invest into, and they'll just invest into different companies. And so they're going to be the ones managing these new startups and companies and helping them grow, helping them with their strategies to grow. And really putting in that work to do that, versus the limited partners are just looking for a return on their investment.
Yeah, so basically this is very similar to what we talked about last week. Just kind of going to break it down real quick for you guys. So like John mentioned, the LPs, they're basically the capital providers. The fund strategy is derived from the general partners. They basically raise the capital from the LPs, they pitch to them just like a startup would, raise the money, and then that's when the actual VC happens, the magic in VC. They'll deal source these companies either through pitch book, through referrals, whatever it may be. Like they can come out of nowhere. Sometimes these companies just are really desperate for money, and they'll look for VCs everywhere. So they'll basically get these inbounds, is what these VCs call, which are just companies coming in looking for capital. They'll hold these companies, and we'll go into what happens during the holding period, what we typically see, and the exit. The exit is really the point of venture capital, is to either exit through an M&A, where the founders make a return on their initial equity, and the VCs as well, and any other stakeholders who have either issued debt to the company or issued more equity. And then that's, at some point, the typical fund life structure is like 8 to 10 years. So what we see is after all these investments are harvested, maybe some fail, the fund itself just closes. So yeah, here we're really just talking about the fund strategy. And when you're raising capital, this is what you have to present to limited partners in order to get the promise that they'll invest into your fund, essentially. So what do these VCs talk about? They talk about the stage of the company they're going to invest in, what sector, what's their expertise, how can they apply their expertise, how many employees are they going to need, what's the management going to look like, where are they going to be located, how are they going to deal source, just all the logistics of actually investing into a company. That's what they're going to do. Then the actual initial investment decisions, that's when it gets into a kind of a gray area, because some of the LPs might want some, how do you say, like oversight on some of the decisions that they make with investments. Because some LPs like to, if you guys remember the private equity presentation last week, private equity, when some of the investors wanted to back out of their investment with the hedge fund, sometimes that'll happen here, and it can get kind of messy when some investments aren't really sound enough for the LPs. But this is typically what gets presented in a fund strategy, a lot of portfolio construction is derived from this stuff. So I'm gonna ask you guys, what do you think is the most important decision VC firms make?
I guess in terms of budgeting, exactly how much money to invest into a certain company.
Yeah, exactly. If there's several opportunities, how much to invest into each company?
I was just gonna say which firm to invest in, because like you could like invest in 100 companies and miss Facebook and just lose.
Yeah, yeah. What is the most important skills VC firms have?
The ability to like analyze a company's like prospect or like how much it's gonna grow.
Fortune teller, I guess.
So like same thing, like being able to search and like evaluate the company to make sure that they're worth our time and money.
Yeah, exactly. How some of the MDs put it in UF Innovate, they're essentially psychologists. Because, like we're going to show you guys, almost a large majority of these investments that VCs make are going to fail. It's embedded in the calculation that they do when they're creating their fund. Very dissimilar to private equity, where you're trying to make sure every investment you make actually returns the fund. Here, they're actually betting on some of these to fail. So it's really interesting, but who they invest in is really important. That's that psychological, the fortune teller aspect of being a VC. It's kind of an art to it, some might say. And then how to identify winners. That's really what they're really skilled at. And people reading skills, that's really what's baked into being a successful venture capitalist.
All right, so moving into the portfolio construction, the fund identity, the brunt of that falls onto the GPs. They construct this when they're opening a fund. So for instance, what you'll see in the middle here is an example of a VC called Hulu. And so their fund identity is threefold. They're looking for a large market opportunity, compelling team, strategic fit. Now diving into each one of these, for the large market opportunity, we'll see this metric, TAM, total addressable market. In VC, these VCs are not looking for 1x return on their investment, 2x, 3x, 4x. They're looking for a 10x. They're looking to return the entire size of the fund, or double the size of the fund, or 10x the size of the fund within their life cycle. This is the mindset that they take in when making VC investments. So typically, VCs will not look at a company that's operating in a TAM less than $1 billion. That's the threshold. But you'll usually see upwards of $1 billion, close to $1 trillion TAMs being targeted by VCs because they're looking for a huge exit within this market. So you'll typically need billions of dollars in the total addressable market. Going into the compelling team, that is, like Darrell mentioned, a huge aspect of venture capital is qualitatively based. It's based on the psychology. VCs will typically vibe check the founders before they do anything else. For instance, when we competed at VCIC, the only reason that we stood out and we placed, in my opinion, is because when we pitched our company, and by the way, we were the only team that pitched this company. Everyone else chose these other companies that might be able to find us had better financials, better projections, better valuations. But our pitch was centered around the team. We understood that the founder that we spoke to was very well versed, right? He had a good, competent team around him. The board is extremely central. So VCs will evaluate the team based off their merit, based off their experience, and based off of the relevance that they have towards the company that they're building. Third, to look at product market fit. That goes into that strategic fit vertical of Hulu, for instance. So basically, are people buying what you're selling? Are people within your market, within your total addressable market, are they going to buy what you're selling? Essentially, that's product market fit. You want to make sure that there's demand for what you're bringing to the table, especially if it's brand new, people don't know about it yet. Will it fit into their paradigm? Fourth, you have scalability. Like I mentioned, VCs are not looking for a small exit, a company to go from point A to point C. They're looking for the point A to point Z. They're looking for the unicorn that's going to return the fund, that's going to 10x the fund. So this business that they invest in has to be scalable, right? Because they're banking on a high growth, high potential company. So scalability is key. Next, you'll have product viability, right? For instance, if you're investing into a software product, is there IP on this software, right? Do you have a repository? Is it a competent UI? Does it make sense for users to use it? Is it easy to use? VCs will literally go in and test your product. If you're making an app, if you're pitching an app first and foremost, you want to make sure your app is easy to use for anyone. So product viability, they'll go in right away and test your product to determine just how easy it is on the user end. Timing is extremely important as well. You're looking for a big exit. For instance, last week at the Gainesville Innovation Summit, not last week, a couple weeks ago, we spoke to the founder of Cameo, right? $1 billion valuation. How did he get there? Well, he capitalized on the timing because he launched his business during COVID when people didn't have a way of physically wishing everyone else happy birthday, right? How are people going to spread love over the phone? Well, he invented Cameo. He pitched Cameo during COVID and it blew up because it was a virtual way for celebrities to get paid to basically wish your cousin happy birthday across the world because you couldn't see him because there was a lockdown. So timing factors in key, right? Good timing means Cameo blew up during that era. Does it really blow up now just as much? Probably not. So timing is key. Finally, revenue streams, right? You go now into the quantitative aspect of a business. Are they producing revenue? A lot of the pre-seed companies, they'll be pre-revenue. So if you're looking really early stage, they'll be pre-revenue companies. But if you're at the Series A level, you're looking for a company that's generating revenue. They might be operating at a loss, but they should be generating revenue. They should have customer traction. That's those quantitative metrics that go into the fund identity. And finally, the cost structure, essentially how you're going to break up, your investment, how much you retain as a VC, how much the company retains, and how much that company, that startup you're investing in, develops its pricing model to kind of bring in the biggest return on investment. So these last two, more quantitative, but a lot of these, as you'll see, are qualitative metrics. And VC is definitely highly psychological. That's why it's very nuanced. It's different than your traditional forms of finance. So, yeah, moving on.
So, I know with revenue streams, I find it a little confusing. I find it a little confusing, not the fact that you would invest in a company that's operating at a loss, but like, at what point it's like I see like companies that have never made a profit in multiple quarters that still get round B, round C investment. And sort of my question is, what do they see in that company when it's continuing to operate at a loss?
So I think one thing that we forgot to mention here for the cost structure is a large part of what VCs will look at before they invest in a company is called runway. We're going to get into that, but cost structure, runway is embedded in cost structure. And runway, it's essentially like what milestones do we have to hit in order to actually produce a profit. So they might be betting on the fact like, yes, they're operating at a loss in the past 4 quarters, but they might hit a profit in 2 years because that's what their milestones are saying. They might have scaled too quickly and that's why they're operating at a loss. They went from 2 employees to 50 employees. They probably entered a new a new geography, and they needed the Series A funds in order to penetrate that. So that's typically the reason why they raise capital in the first place, in order to meet these milestones. And then once they have that market base that makes them sustainably profitable into the future, that's when you start thinking about exit opportunities.
Okay, thank you.
All right, so moving into the fund strategy even further. So we have here a framework, 6 steps. First and foremost, sorting qualitatively. Like I mentioned, VCs will conduct what we call diligence calls, initial diligence calls, where they're gonna hop on a call with a founder and essentially vibe check that founder, right? The founder does not pass the vibe check. The founder is not, obsessed with their product. If they don't have the relevant ability to answer pointed questions from the VCs, this is all a qualitative screen that basically tells a VC whether or not this founder is worthy of moving on to the next stage. So I can't stress this even more. You gotta pass the vibe check as a founder if you want to get funding.
Isn't that what we saw today?
Yes, I was judging a pitch competition today, and let me just say, founders that don't pass the vibe check, it's hard to listen to anything they say afterwards. So next, we have creating a market map. So essentially, you want to map out, when you're doing your due diligence, you want to map out a competitive analysis. You want to look at, comparables. You want to get a good grasp of what this market is, right? The total addressable market, but also the serviceable addressable market. Some other metrics drilling down within that. The TAM, the SOM, the SAM, all these different KPIs. You want to have a great understanding of that, and that typically falls under what is a market map. So Furthermore, you have to perform a risk analysis. So there's inherent risk in VC, right? You're looking at a 90% fail rate, and people know this going in, GPs know this going in, but yet you still have to assess and identify your risk clearly because you need to justify your investments to your LPs. So understanding risk is key with an investment, and so going into like step 6 with the risk-return ratio, and so understanding that risk and seeing if it's even worth it to take that on when you're investing, quantifying that risk into a risk assessment. For instance, in doing due diligence, in my experience, funds will build out these complex risk models that will really put it into terms of you can quantify so many aspects of risk in a company. And it's important that you're really diligently doing that too. And that kind of leads into sensitivity analysis as well. You want to see, is this company going to withstand a downturn? Is it resilient? Because early stage companies are so volatile that you want to make sure you're investing in the one that's going to stay standing after a storm comes through, and not the one that's just going to get blown to smithereens. So you want a company that's going to withstand tough market conditions, whether a pandemic arises, right? Do you trust the team? Do you trust the business model? Do you trust the product enough to withstand any and everything that may arise? And then finally, that goes into your final risk return. That if it falls within your threshold quantitatively, then that's usually when they move forward with an investment. So when they believe that the return is there, it's within the 5x, 10x range, and typically you see them put in the capital at that point.
That's for some firms. Like some firms are straight on the buy check, but some firms are more quantitatively focused. There's a lot of firms that they try to quantify the risk through machine learning models. It gets really technical, but most of the time it's either through quantitative analysis of the actual market conditions and the market penetration, or the actual buy check that the VCs conduct. So we kind of also went over this for the PE aspect, and I know what some of you guys might be wondering, if you've researched VCs before, like they all sound the same. Where they might differ and in their investment thesis is what size of the check do they cut, meaning how big of an investment am I going to give this company? Is it in the range of 1,000 to 10,000? Is it 100,000 to 1 million? Or is it 10 million to 100 million? It depends. They have the check sizes. They have what sector they're going to invest in. We're going to go over it later, but most of the time it's tech companies, SaaS companies, because if you run margin analysis on these companies, SaaS companies have the largest margins out of any business that you'll see. That's typically why VCs try to lower their risk by investing into SaaS businesses. In addition to that, they'll invest in multiple SaaS businesses at the same time in order to elevate their investments. So that's what we see. You'll see a lot of what makes our VC different. It's almost the same, except for those two criteria that I told you guys. Check size, what sector they invest in, and how they actually analyze their investments. That's what makes a VC different. So now we're going to get into the actual investment. What does an actual investment in VC look like, and how do you actually put a price on a company? That goes into this term sheet.
All right, yeah. So what is a term sheet? This is a key, part of the deal between a VC and a startup. So a term sheet is quite literally just a sheet, right? It's not this long, super, verbose contract that you would expect in a venture capital investment, because it is not a legally binding document, right? It's a precursor to that huge contract when they sign that deal. This needs to be established before any deal gets pushed through, before any paperwork, legalese. The term sheet needs to be finalized. So the VC and the startup, the entrepreneur, they sit down and they iron out these terms. And it's extremely important from both ends to understand how these terms work, who they benefit, and what they mitigate. So, I'm not going to go too in-depth in each one of these terms, but just to get an idea of what they discuss. So first they discuss the valuation, the pre-money valuation, the post-money valuation, and the investment. That's ironed out first and foremost. And then you get into a liquidation preference, for instance. So this spells out what happens when this company exits, right? Who gets the returns first? Because there's preferred shareholders, There's common shareholders, there's usually multiple investors on the cap table, there's the founders who have their equity, right? Who gets the money first, and so forth. And typically, the VC investors are going to push hard to get, one, they're going to get preferred shares in the company, and two, they're going to get the return on their preferred shares before anyone else. So liquidation preference is huge. Next, you have dividends. This is not typically a huge term in VC investment. But you also have conversion to common stock. Like I said, that distinction is key in VC. Preferred shares versus common shares. Most VCs are going to want those preferred shares, and they're going to want their rights, the voting rights, and et cetera, the preference that comes with those preferred shares. But they can have provisions that convert their shares into common stock if that suits their purposes. Finally, you have the voting rights. So a lot of the times you'll see the board get established on the term sheet, where VCs, if they deem that a startup, we like the team a lot, but they could use help. We want someone on that board. They'll typically iron that out, where they'll say, we are going to invest X in your company, but we also want a board seat. And sometimes they'll take a board seat, sometimes they'll take 2 board seats. But the point of that is that gives them a lot more voting rights and controls internally over what happens in that company. So the board seats are another huge point of contention. If you're a founder, do you want to let this VC onto your board? Do you want to dilute your equity, dilute your control in that way? As a VC, do you trust a company to grow without someone on that board to physically monitor it? And then some other technical terms like drag along. This one essentially talks about the conversion of shares in different voting scenarios. Let's see, some other key terms.
I'm kind of curious. Do you guys know the difference between preferred and common stock? No? Wait. Really? Probably should put that first. Preferred? Does anybody want to give a stab at it before I ask it?
So preferred shareholders get voting rights in the company, and also if, for example, the company doesn't have enough money to pay out dividends and stuff, then the preferred stockholders will get paid for the common stockholders. Exactly. So basically, you just have priority in earnings and vote.
Exactly. The reason why early investors want preferred shares first is that in the case that these companies go bankrupt, which we typically see most of the time, this term sheet is basically just a way for a VC to hedge as much risk as possible onto the company. So what we see is they want preferred shares to get liquidation preference. In the case the company goes bankrupt, they want to be the first people to get any capital that's available to get returned back into the stakeholders. Typically, what goes first are the debt holders, but you could see venture debt being applied to some of these startups. It'd be really silly, especially today, but that could be the case where the debt holders get paid out first, and then the preferred shareholders, and then common stockholders. That depends on the case that we're looking at. But that's just wanted to clarify that first.
I thought preferred shares didn't have voting rights. That's why they were preferred. It's I know it's
that's right.
In the general stock market, preferred shares no voting rights, but you get an extra dividend and you get preference in liquidation.
Yeah. Sorry.
Is it different in VC?
No, it should be the same. Good catch.
And this all goes to show that it's a twofold struggle in it. As an entrepreneur, if you let the terms get overly dictated by the VC, your equity and your control of the company could dwindle. That's why it's super important to establish fair, just terms at the start of an agreement.
You don't get voting rights, but that's why you have this board term right here in order to place them on the record.
All right. So essentially, what happens in the interim, after the investment and before the exit? So first and foremost, a lot of VCs in their fund identity, they will typically be upfront about, we're a hands-on VC or we're a hands-off VC. So what that refers to is in the interim what they do, the value-added services of VC. So a hands-on VC is going to offer strategic guidance, networking opportunities, operational support. So the strategic guidance is they could bring in entrepreneurs and residents. They could bring in subject matter experts within their network. And typically the larger VCs will have a vast network of subject matter experts, successful ex-entrepreneurs in the field, and just giving these founders a lot more support beyond just the money. So that's kind of how they pitch themselves. VCs want to, differentiate, because VCs also, you have to understand, they're also battling amongst themselves to get the best deals on the market. So this is how they differentiate themselves. They'll say, oh, we provide, subject matter experts. We got mentorship. We have a vast network that you can tap into as a founder for help. We'll support you in your operations, like hiring, and if you have a board seat, they can also have more hands-on support in the operations of the company, and basically just kind of giving you a helping hand throughout the way. But some VCs are very hands-on, where they'll deploy the capital. They'll say it's up to you. Again, that depends on the vibe check, depends on the trust in the founder, but this is what VCs do to kind of differentiate themselves and also provide more than just money as a value to these startups.
Does anybody know or want to take a stab at how this right here differs from the value add private equity shop offers? Because like we said, VC is a form of private equity, but like we mentioned in the past lectures, colloquially how we think of private equity. How does these values or these services differ from the private equity shop?
Private equity, they might change the leadership of the company. They don't usually keep the same leadership management.
Yeah, exactly. So more hands-on, you would say.
A little side note, also private equity shops are known for laying off people.
There you go. Completely revamping and changing up the whole business. Whereas here, it's like they're kind of.
Yeah, in VCs, it's almost exclusively their stake. They're taking a minority stake, whereas in PE, they're taking majority.
There you go. That's what I was looking for. And with that majority stake, they have complete control over the business. Whereas here, VCs would typically go for 15 to 25%. So in a cap table, basically the owners of the company, whoever has more than 50% has majority ownership and complete control over the company. But the VCs are just looking for minority share and just trying to be like the guiding hand for the business. Very different from a VC or from a private equity shop. So what we'll see here is at the end, kind of what the point of VC is to get to that IPO or the acquisition part or the PE buyout, where you actually get a private equity firm to raise that and actually buy out this company in a majority share. That way capital can get reimbursed to all shareholders or stakeholders. And really what we see is trying to aim for the acquisition. It's probably the lowest hanging fruit. IPO, especially today, is really difficult. It depends on which market we're in and which one of these might be more likely. For example, if we're talking about peak COVID, 2020, 2021, a lot of IPOs happening. That's probably more likely the case for a SaaS business, for example. Or if you see maybe 2000, 2001, IPOs might be more prevalent as well. Acquisitions and PE buyout might be more likely in lower interest rate market conditions. So these three depend. You kind of weigh these out in the harvest analysis. This is what VCs do to kind of see how they'll actually make their money back. And also the interest that they generate through their network and book building.
All right, so here we have the venture capital lifestyle framework. So 75% of venture capital backed businesses fail. So over here on the far left, you have the entire fund. So this is all the money that's given to them from pensions and the other limited partners. And then so from that, there's a 22% fee overall. So you lose about $60 million on a $300 million fund. 20% of that is going to the ending profit of selling the company will be going to the DC fund, and then 2% is management fees for that VC fund, so they can just continue operating and continue looking at investing in different companies. And then from there, you have the 25% of companies that will make you money and will succeed and greatly increase their valuation versus the 75% that don't. So you're looking for that 25% of companies that are able to make that money to support your whole fund and hopefully return as much profit as you can for your limited partners and for yourself, and through those collectible calls to 20% for the fees.
Where you said so 2% went for management fees, and then what was the remaining 18%? like the bulk of the fees?
Yes, so typically VCs will have a 2 and 20 structure. So 2% management fees. So say we have a $100 million fund. So the 2% management fees will be deducted on a yearly basis. So of that 100 million, 2 million is going to be for the GPs. It's going to pay their salaries. It's going to handle the expenses within the VC fund, the operational expenses. So that 2 million goes, just to keep the fund running for a year, right? And then the 20% happens in the event of an exit. So say they get a huge return on the investment. So $100 million fund, say they double the fund with an investment. Say exit at 200 million. Well, first and foremost, all the limited partners, right? The initial people who deploy the capital to the GPs, they're initially going to get all of the they're going to get all their initial 100 million back when they first created the fund. They're going to get that 100 million back. Then, with the remaining 100 million of that $200 million exit, what happens to that? That's a 20% carry fee, where that then goes to the general partners who sourced and invested in that deal. So, does that make sense?
Yeah, it does. Thank you.
So here we're looking at the average venture capital return on investment over an 8 to 10 year period, so the typical period for a fund. And this rate of return has been increasing over time. And then as you can see, the median's higher than the average. Does anyone know why that is? Or why the average would be higher than the median?
Because there's some startups that do way, way better than the majority of the group.
Yeah, so some of the VC funds are outliers and are making much higher returns. So that's drawing up the average, whereas the median is staying fairly consistent. But the average rate of return is increasing over time. So now we're going to go over the 3 dimensions of VC. The first being their financing. So which of these do you think would be the most important or the biggest financing opportunities for entrepreneurs and the people that are starting a company?
Friends and family.
So the amount that's actually given the most to startup companies is venture capital, but the first place that startups will go to, other than their personal savings and their own money, is through friends and family and business loans. Before they have to outreach to VC firms and angel investors for larger sums of money to really get their business going.
So really there's very creative ways to start receiving financing at early stages. So there's a really interesting one called convertible notes. And this is one that we see that a lot of founders here in Gainesville actually do through friends and family. I'm sure this is nationwide, this isn't just Gainesville focused, but essentially what a convertible note is it's debt with an applied interest rate on it, but it has the option to convert into equity at some point in the future to common stock. I don't think it'll be preferred, but it has the option to converting into equity. When would it convert into equity? It would depend on the valuation of the company through a pre-seed, seed stage, or Series A, B, and C further on. It depends on the terms of the note. So a lot of debt that gets issued always has terms attached to it. So most of the time what you'll see is the note will not convert until this company reaches X valuation or they raise X amount of money. In that case, my note is equal to the fair value of the note at the time. Either the fair value or the principal plus interest at that time. So it'll depend. Like if they issue a $1,000 note at a 6% rate, it'll be worth $1,060 at maturity, right? And then that you equal that to the amount of whatever the convertible rate is from equity to debt, and that's how many shares they get from the value of shares to the number of shares. That's how much equity they'll get. But this is a really interesting one because it kind of it's not as risky as just giving capital up front without an expected return on it. It's kind of like, okay, like even if they fail, at least I have a guaranteed rate of return on the capital that I give this business through the debt that I issue. But also in the upside case, I'm still hedging against that because in that case, I'll get a higher rate of return through the shares that I get issued through this convertibility. So it's a really interesting one, and it's very common in venture capital as well.
I was going to say, it's like commonly practiced with venture capital or VCs, or is it more of like a individual, like family, friend, safe kind of
Yeah.
thing?
It's a very friends and family, maybe angel investor focused. A lot of VC or like early stage investing is very case by case, but it's very common in those early stages of financing.
So you're looking for, whenever a venture capital company is looking to invest in a different company, they're looking for 3 different things, and it's kind of their specialties. So the startup stage that they're in, pre-seed, seed, round A, B, C, etc. The industry that they're in, if they have expertise in that industry or more connections to that industry. So tech or SaaS, as mentioned before, healthcare, just any possible industry. And then typically they're going to want to have a geographical relation to them, so somewhat close, so that they're able to check in on the company and work with that company and help them grow. So here we start with the different stages. So when you're raising money from your own money, your friends and family, you're on the idea stage, part of the pre-seed stage. This is when you're starting to develop that minimum viable product through the seed stage, and that's really the early stages. And then as you move on to Series A and so on, you're looking for more of a product that you can sell and more traction in the market. And typically, VC companies will raise about $110 million in total, but it could go higher than that. That's just the biggest that it typically gets to, not in valuation, but the money that they've raised. And they'll move through the idea stage, then to the early stage, where they have their product developed, then to the growth stage when they're really trying to expand into the market that they've entered, and then the late stage and the exit whenever they're looking for a merger, an M&A, the IPO or the leveraged buyout from a private equity firm. So here's just some more in-depth portion of the startup stages. So you start with raising money from your friends and family to help you get a concept or an idea turned into something that you can make a business out of. So money is used to set up the company and develop this first MVP. And then between pre-seed and seed, it's hard to differentiate the two, and there's a lot of gray overlapping between the two. So this is when it's first entering the market and you're trying to just establish yourself as a company. And then so the pre-seed and the seed are the first real rounds of financing. But after that, when you get to Series A, that's when ever the bigger dollars come in. It should be growing every time. And if your valuation ever decreases between your rounds of funding, it's a sign that your company's not looking to succeed in the future. And then continuing Series A, B, and C, etc. Your company can go through as many rounds of financing as you need, but typically companies won't invest in you if you're not growing in that valuation. So some of the major the major venture capital firm in the United States is Andreessen Horowitz. So they have a $36 million fund, and again, like I said earlier, the market share for total VC funds is 63 billion, and they're at 36 billion. So they have more than half the market share, so they're investing in a lot of companies, not only just Series C and above, but they have hands everywhere in all stages of startups. And then Google Ventures is a factor of Google. So they're looking, it's their venture capital part of the company, and they're looking for companies that are similar and trying to invest in them early and then either integrate them into Google later, or just help them grow and then integrate them just for a lower cost since they're investing in them early. So here, again, we're going to see kind of the steps of a startup. So here you have the pre-seed and seed, and then you'll move into A, B, and C fundraising, and then you'll see these little steps. So that's where we're really talking about the runway. So where you need to hit a certain level of financing in order to buy buildings or hire a certain number of employees, so you can start making revenue and then eventually turn that into profit. So that's where you have these little caps, like the steps. And then you're slowly moving towards your IPO, leveraged buyout, or the M&A. And then so after the ABC rounds of funding, you have the mezzanine funds. So those are funds that know that a company is going to be fully bought out in an M&A or IPO soon, and there's traction on it, they're 100% sure that's gonna happen. So they're gonna invest with very low risk, but also a low reward as well. But it's a safe investment, you're still gonna make money. And so that's where the different levels of investing are. And then if you're looking at the secondary offerings part, you can see this value of debt. That's before, when you're making revenue but you're not making any profit, you're just kind of burning money either through research and development or establishing yourself in the market. And that's where you're going to be burning a lot of cash and you won't be profitable. And then eventually you'll start working towards being a profitable company and eventually IPO or something of the sort. And now we'll be looking at the sectors and industries. So the biggest sectors that people are looking to invest in are software, or in the US are software and commercial products as of 2021, and then also software in Europe. So the reason for that is because there's the high rate of return for those companies that are being invested in, and they have high levels of growth and possibility for growth. So different VC firms will be focusing on one of these different industries. Like Silicon Valley is very known for its software industry, so there are going to be a lot of VC firms that are investing in software there. So here's some examples of venture capital firms in different regions that are looking for different geographical locations, different industries, and then as well as the stage. So Spark Capital, based out of San Francisco, has invested in Twitter, which is now X, Oculus, Coinbase, and Grammarly. So they're looking at those tech and software companies. Summit Partners is out of Boston, and they're also looking for tech companies. So Boston McAfee are software kind of protection programs that you can get on your computer to protect yourself from viruses. And then Uber, getting around, another software company. Stripes, you have another VC firm that's focused on more consumer and software, so the On Shoes, the CIED chips, and Monday.com, just brands that we see around our lives. And those are the three main locations for VC firms currently. When we'll get on to that in the next slide. So the geography. So in the past, the main areas for VC have been the San Francisco Bay Area, Silicon Valley, New York, and then Boston. And then the growing regions are Texas and Florida. This graph is outdated from 2021 as well. But Texas and Florida have grown significantly since COVID. Especially, just there's been a lot more startups here. There's a lot of innovation happening in these two regions specifically. There's a lot of VC firms and investing firms that move to those regions. And now the venture capital philosophy. So what is the most important factor in decisions that VC firms make, if they're qualitative, which for the most part they are? Pick someone. Andre.
I can't read. I don't have my glasses.
It says, what is the most important factor in decisions that VC firms make?
It has to be quantitative or it can be
I
qualitative?
guess the scalability of the company.
I was going to say the entrepreneur himself, how to pass his vibe check.
Exactly. Vibe check. Key. So the founder, and the founder is important because the founder is important. So the founder is important because you get to see how much they're invested into the company. If they really believe that they can make a change in the market, in the industry, as well as in the world, with the company that they're developing, and they have that drive to see the company succeed, and they're going to develop a workplace where their employees are able to push past what they think they can do and really affect the company and help it grow to new heights and help the VC make a return on their investment. You also have to see that the founder has past experience and skills and is able to manage and run this company in a way that's effective and allows them to grow.